Hi Fools, welcome to Friday's edition of Market Checkup. I'm David Williamson and this is Michael Douglas. Michael, thanks for joining me.
Happy to be here.
And we got a full show for you today. We are going to start with the winners and losers as we like to do here, see who's winning and losing. It's supposedly been winning this week though. We're going to move into some headlines. We have some good ones for you. Then Obamacare, as we're wont to do, and we're going to finish up with a great game of over-under. So let's start with the winners and losers. Our big winner today is Endocyte, though, and really that makes it a winner for the week because it is an instant biotech double. Shares are actually, they were up over 100%. They've traded back down to between 90 and 100%. Still a good day's work in the office.
Yeah.
Michael, what caused this pop?
So there was a positive clinical trial, a phase 2, on vintafolide for lung cancer. And that's, we think, going to make a pretty big difference for the stock.
Yeah, well, it wasn't just the vintafolide catalyst, and for those of you out there who may not be following it, when you combine vintafolide with chemotherapy, it had a 25% benefit in both progression-free survival and overall survival. Mm-hmm. Plus, there was actually positive news coming out of the EU on vintafolide as well. It received approval in ovarian cancer, so it's now an approved drug. It's got great results in lung cancer. Piper Jaffray loved it so much they maybe a little after the fact more than doubled their price target from $17 a share all the way to $36. Shares are currently at 28, so Piper sees some upside, and you do too, Michael.
Oh, for sure. I mean, when you look at the fact that for just the EU indication, we're looking at about a $400 million peak sales, probably, something like that. You tack on the US, we're looking at blockbuster potential. And when you look at a market cap right now of plus or minus $1 billion, even with today's double, that means we're looking at a price to sales of, what, 2.5? Lots of potential upside there.
Yeah, and Endocyte is, vintafolide actually is interesting in itself. It's in going for 4 different indications. It's obviously got ovarian cancer in phase 3. Mm-hmm. It's got lung cancer in phase 2. It has another phase 2 and a phase 1 indication as well. It is 2 other drugs. One's in phase 3, the other's in phase 1. So it's not just a one-trick pony. It's got a bit of a pipeline, and I consider vintafolide success as it speaks well to Endocyte's platform. Mm-hmm. And they have a big pharma partner too, which is always interesting when you think about buyouts. Merck paid really big money to get vintafolide, $120 million up front, about $880 million in milestone payments. So, they're going to pay $1 billion up front for this drug. So they see those blockbuster sales that you're talking about. I mean, it's a payment that rivals what Johnson & Johnson did for pharmacyclics for ibrutinib. Now, I'm not saying vintafolide is going to do ibrutinib, which is, targeting peak sales of $6 or $7 billion. But this is definitely a drug to watch. I think it's a nice feather in Merck's cap, and I think Endocyte in particular is a stock that really should be on every fool's radar.
For sure.
All right, let's move on to another winner for our week. Now, this is a stock that had a pop earlier in the week, but was really one of the better gainers out there, and that's Horizon Pharma, which is fleeing the apparently oppressive U.S. tax system and heading off to Ireland. It purchased an Irish pharma company called Videro Therapeutics for $660 million. The new company will be called Horizon Pharma. So they're keeping their name. Shares popped 17% on the news, are up 23% for the week. Horizon, they're not just buying an empty shell here. It is going to help them. The company has multiple approved drugs. Mm-hmm. After Q4, management was guiding for between $190 million and $205 million in 2014 sales. The new company is now guiding for $250 to $265 million in sales. So investors were really applauding the lower tax rates and the bump to the top line.
Right. Well, and this has been a bit of a pharma trend, right? This sort of movement to Ireland or somewhere with lower tax rates. I mean, you saw activists about Warner Chilcott for exactly this reason. As long as it makes sense, I think this is going to be a trend that's going to continue. It saves money on the bottom line, and it's a good deal for shareholders.
Yep, I think that's absolutely right until the tax code gets reformed in a way that these companies are happy with.
Right.
I wouldn't be surprised to see them flee for havens like Ireland. Mm-hmm. All right, so let's move on to our headlines, and we have a bunch. We got some really good ones for you. Let's start with AGs on the attack. 28 state attorney generals have come out to urge large retailers, this is Walmart, Kroger, Safeway, Walgreens, Rite Aid, to stop selling cigarettes. And this is something we talked about when CVS decided to stop selling cigarettes. We said yes, they're giving up sales, but it's going to really reposition the company, and they're really going to be at the forefront of this movement. And this is exactly what we're talking about, because in every single article I read on this, CVS was mentioned in a positive light because of how they changed without being prompted. They were ahead of the change, and really I think a lot of these companies now are dealing with the after effects of CVS's decision.
Right. Well, and hey, we just talked about CVS, right? I mean, the moment we brought it up, we said, and by the way, CVS, right? And it's interesting because you see sort of two different groups here, right? So on the one hand, you've got Walmart, you've got Kroger, and you've got Safeway, and they're kind of your traditional, Walmart's a big box store, but they're kind of your traditional retailers, right? They've all got pharmacies. None of them really offer the sort of clinic piece that we see with the Minute Clinics in CVS. Although Walmart does have these outpatient clinics that are operated by local hospitals and things like that in about 20 states. Walgreens and Rite Aid, different story. So we've got Walgreens has the healthcare clinic, which used to be called the Take Care Clinic, which is their answer to CVS's Minute Clinic. And then you've got Rite Aid's Now Clinic concept, which is currently in 3 states, but they have this sort of telehealth version of it where you can kind of get online or on the phone, on video, and chat with a healthcare professional and perhaps get a diagnosis that way. And that's sort of going broader in a lot of different states. So that's a very interesting development, I think, for Rite Aid. But what it means is that Walgreens and Rite Aid are more directly applicable and comparable to CVS, even though they're not doing the sort of PBM work that CVS is doing. So it means that they're going to be more and more open to this kind of criticism.
Yeah, I think it's going to be interesting to watch how management at Rite Aid and Walgreens reacts, because the avenue to growth for these companies is as healthcare providers, right? You're not going to grow that much by adding more, consumer discretionary,
Sure.
and retail sort of items. You're going to grow by growing your brand as a healthcare provider, getting that sticky relationship, seeing patients. The Affordable Care Act makes this a real pathway to growth. I think these other companies, by watching what they're doing as far as comparable to Minute Clinic and other innovations, I wouldn't be surprised to see them jump on the not selling cigarettes bandwagon as well. It'll look a lot better for them if they do it without dragging their feet. I think it won't look as well if they make that transition kicking and screaming. So I'm going to look for management and see how they respond. When you look at the numbers, you're like, okay, it's $2 billion in sales. That's a large number.
Right.
That's startling. You're saying, okay, you're just washing your hands of $2 billion. I don't want that, is what CVS said. But when you look at the amount these companies actually sell, it's kind of a drop in the bucket. And in the grand scheme of things, I think it's probably better for their brand and for how they grow their business to make that change.
Right, and it's going to be a little bit of a bigger percentage, I think, for their sales than for CVS, because they don't have the prescription benefits management piece also adding.
Which is Caremark.
Right, which is Caremark, adding to their earnings per share and their revenue. But at the same time, it can't be that much more. And so I really think that it's going to end up ultimately long-term being worth not getting attacked and sort of having their names kind of up in lights with 20 attorneys general writing letters and things like that against them.
Yep. And for those invested in tobacco companies, I wouldn't be too worried about loss of distribution channels. I think smokers will still find their cigarettes just fine.
Yeah.
I think this is more about how these pharmacies change going forward.
Right.
Okay, let's move on to our next story, which is about generic threats. And, we've actually seen, it's really kind of a 2-part threat, quite frankly. We have possible regulatory changes here at home, and then some stuff happening abroad. Let's start with the regulatory issue. And this is a proposed FDA rule change that would make generic drug makers liable for the safety data on their drugs. Now, that when you hear liable and drug makers and you're a shareholder, very scary.
Right.
I'm going to put that right out. But when you actually look at what this is about, it actually seems kind of like, it seems more of a common sense reform to me. And it does seem a little ridiculous that the branded drug that the generic is copying can have a different, more comprehensive safety label than the generic drug. And, I do know the Generic Pharmaceutical Association disagrees with me. What do they call it?
Ralph Nees, who's president of the association, said it would be nothing short of catastrophic.
Yep.
But I mean, let's be honest here. Okay, first off, it is hard to model exactly how much liability could end up coming in here. But this is fixing a label, and frankly, this is fixing a label in a way that makes sense. So if you take the branded drug and there's a chance of cardiovascular events, it'll say so on the label. When you take the generic of that drug, if there's a chance of cardiovascular events that they found out about after the generic was created, it should still say that on the label. This is definitely very much a common sense reform. I mean, of course, we'll be looking to see what kind of your major generics are talking about here. So, Teva, Novartis, Milan, Abbott, Actavis. But I just don't see this being that big of a problem for them. And this isn't something I think that will really, that's really going to end well for them if they keep fighting it.
Well, it's sort of silly. I know generics are a low-margin business, but I can't imagine updating the label is going to shave that much off the company's profitability. And people need to feel like their drugs are safe. What's really going to hurt them in the long run is if generic drug makers dig in their heels and it becomes a larger media issue, and people become nervous that when a doctor prescribes them a generic drug, that they might not be actually getting a safe drug because they don't know about all the side effect issues. So we actually could see a push where patients demand the the drug because they just feel that like it's a safer product, even though they're completely identical. But that could end up being sort of I don't want to say misguided takeaway because they're going to have the same side effects either way. But people, if they're just seeing headlines, generic drugs may be, unsafe. They could take away the wrong headline that, oh, I need to go with the branded drug. So you could see some pressure on generic drug sales if they dig in their heels and if this becomes a larger media controversy. But if I can speak to safety, we're seeing some safety concerns coming out of generic drugs that are coming in from other countries as well, India in particular. Right.
Well, and as I recall, actually, in response to some of that, Milan's president said something like, well, when there's a problem in one section of the generic sector, it affects all of us. And so when you hear something like that, that makes you think, okay, you know what, if the generic sort of primary lobbying association is saying, hey, we're against this change, then that's going to affect some of these generics long term. Yeah. So really, this is a story I think we're going to be watching very closely to see what develops. But I think the good public policy and sort of the good investing here are going to kind of align here.
Yep. And I think when you combine that with what we're seeing out of India, which are some manufacturing concerns related to safety, it's just painting a kind of a, maybe with an unfair brush, but a murky picture around generic drugs, and you don't want, right, 80% of drugs are generic.
Right.
And so that's the large portion of what we prescribe, and that's really a great way to keep healthcare costs down. But if there's just a lot of concerns over them, that could really be a headwind. I'm not foreseeing anything that dramatic, but right. This seems like some sort of common sense reform to just get the labels updated and clean up some manufacturing practices overseas, and we can just keep chugging along like we have been.
Yeah, it seems pretty simple.
All right, well, let's move on to our third headline, which is something I'm going to call Statins for All, because there are some new guidelines coming out. This is courtesy of the New England Journal of Medicine. I saw this regarding cardiovascular health, which recommends adding another 12.8 million Americans to those on statins. And for those of you keeping track at home, that means essentially half of the American population between ages 40 and 70, which is 56 million Americans, will be on statins. Now, these new guidelines, Michael, came from, instead of working to lower bad cholesterol, which is what we've been doing, there's an online calculator that factors in all sorts of things like smoking and obesity that would contribute to heart disease. And if they're over a certain threshold, I believe it was 7.5%, they should get statins. Now, there has been some pushback on the calculator. It seems to me like it might have been powered by the sales department of pharmaceutical companies.
Right. Well, and there was one person who I think said something like it's sort of an ignore the numbers calculator, sort of arguing that they really should have kept with kind of the old numbers. I mean, to my mind, of course, the first thing people think of are your big branded statins, right? Lipitor by Pfizer, Zetia by Merck, and Crestor by AstraZeneca. But of course, at the same time, we're seeing a lot of movement by generics into this area. So my big question for you is, who do you think is going to benefit the most? Are we going to see at least a short-term bump for these for these branded drugs, especially considering that Crestor and Zetia aren't off patent until 2016, or are we going to see some movement generics? Who's on top?
I think that assuming doctors do go with the online calculator and
Right.
these 12 million new patients show up, obviously that's a sizable boost when you're talking about 56 million overall. That's a nice jump.
Right.
I would think the volume would largely go to the generic drug makers as it stands now. I think the company that might be poised to benefit long term, though, would be Pfizer if they can get Lipitor approved as an over-the-counter drug. Because if you're, quote unquote, prescribed it, or you now need to get it, but it's really easier, you can just walk down your aisle, pick it, throw it in the cart, and call it a day. Pfizer can have that shelf space. They won't have really the same type of competition. They won't deal with doctors deciding, what the patient gets. They can win with branding at that point. Lipitor is the best known of these. It was the best-selling drug in the world. Did over $10 billion in annual sales before it went generic. It's still doing $2.3 billion as a generic, which is just monumental, quite frankly. So I think Pfizer, if they can get the over-the-counter status approved, that is no slam dunk. The FDA is going to be really tough on that because they're concerned that patients won't know how to take it quite right. But that is something to watch, and that could ultimately be a boost to Pfizer.
Sure, that makes sense.
Okay, let's move on to our regular recurring segment, which is Obamacare.
Obamacare.
We love covering Obamacare here, and it's because there's always Obamacare news, Michael.
That's true.
And we have quite a bit of it. Today we have really a whole slew of regulation changes. I think we should probably start with that. The CMS released proposed rules on the exchange standards. They're filled with just a ton of nuance. We won't bog our viewers down with that, but it involves product renewals and discontinuations, the small business program, but also there's plans to avoid network narrowing.
Right. So previously, network narrowing has been something that insurers have talked about doing as a way of saving money, and the Affordable Care Act has required them to keep, I think, 20% of essential community providers, which the Washington Post has helpfully defined as health centers, other hospitals, serving mostly low-income patients. That percentage is now being upped to 30% to basically ensure that even if the health plans need to save money by making sure they contract with certain providers and sort of have that flexibility in the market, that they also have to cover enough people and enough providers that people have the opportunity to really kind of get the care they need where they need it.
Well, it's tough because it's one of those things where on a policy level, obviously you want to avoid network narrowing.
Right.
You don't want people to have less choice. It's been defended so far as saying, well, you can pay for the cheapest plan, or you can pay for the most convenient plan based on networks. And networks have always been part of the healthcare process, really.
Right.
But it's hard when you see this sort of narrowing to how do you legislate that away. And we've seen some marketplaces where this has actually been successful, just on its own, naturally occurring, essentially. California and New York, in particular, have become noticeably more competitive. But then you take Connecticut and Washington, which are less competitive than where they were in 2012. So, I think it's going to be potentially tough to fix this outcome. I think getting more insurers in each state's pool will help. A lot of the insurers are just dipping their toe in the water, doing just a few states at a time, and so I think that's really going to be part of it. Can you get Cigna, Humana into more than 10 exchanges? Because the more you have in there, the more plan options you should have.
Right, exactly. And United Health, too, has also taken kind of a wait-and-see approach. So I worry that legislatively this is going to be a little bit of a case of whack-a-mole. You sort of, one problem pops up and you get rid of it, but that then causes a couple of other problems because they need to find a way to be profitable. Something that's probably not going to help long-term is the issue of the sequester, right? So currently they're estimating about $731 million in sequester cuts are going to hit the reinsurance fund, which is helping maintain those risk pools for these insurers.
This is the Obamacare bailout.
Right, exactly. To assure that basically insurers don't lose so much money in any area that they then say, oh, well, you know what, we're done with the exchanges, right? As Aetna's Mark Bertolini has threatened a couple of times. So that's also not going to be a plus. Although, to be honest, when I look at the numbers, it looks like we're kind of in a make a little, lose a little, breaking even kind of way. I mean, you've got Aetna on the one hand saying we're going to lose money. Humana expects to lose some money. WellPoint expects to make some money. So we're kind of, I think we're going to know more in a couple of weeks, maybe a couple of months when all the data is available.
Yep, and I think it's going to be interesting to see. There's already been some concerns. I don't think that we'll hit that threshold necessarily on this round. There have been some concerns we've seen about rates going up pretty dramatically for next year. Aetna's CEO has sounded the alarm on that, and they're not afraid to leave states. State commissioners can obviously regulate the amount of price increases. Some concerns that even have it doubling, so obviously I think state commissioners would whack that down. But as I was saying, Aetna is not afraid to leave states. They left Maryland when Maryland said no to the price they submitted. And so you could see companies pull out, which gets back to the narrowing issue, right? With how do you get more people in, more coverage in if they don't like the price that they have to sell that coverage at. So it all sort of comes full circle as far as loss and what you can charge.
Right.
As far as any other changes, the one thing else that caught my eye is the CMS extended the low-volume Medicare-dependent hospital program for an additional 6 months. This is for essentially rural hospitals. So LifePoint would be the stock that would benefit the most from this extension. I do want investors to keep in mind that it is only a 6-month extension, so it will take them through about halfway through this year. Hopefully, LifePoint can continue to argue the point and maybe get a further or more permanent extension of the program as well.
Right. Well, and there is one other issue that I'd like to go ahead and highlight, and that is the issue with the 90-day grace period that has been kind of becoming a little bit contentious with the AMA and some physician groups really becoming concerned about it. Basically what this says is if someone signs up for health insurance and they get the advanced premium tax credit, which basically means that they are getting a subsidy from the government, and then they have basically 90 days to pay that first premium before the insurance is cut off. And during that time period, for the first 30 days, the insurer has to honor their claims, even if they haven't paid. For the next 60 days, and this is the rule change, because previously it was that they had to do that for all 90, but for the next 60 days now, the insurer can say, well, we're going to mark it as pending. We're going to wait and see if you're actually going to pay. And then we will reject these submissions if the person doesn't pay. Physician groups, of course, are very concerned because this is potentially going to shift a lot of costs over to them that they hadn't previously taken. So, of course, folks in hospital stocks, folks like HCA, community health systems, LifePoint and Tenet Healthcare are going to be a little bit concerned, saying, well, is this material to my investing thesis? I would say probably not. And the reason is that since these hospitals are really writing off so much to bad debt anyway, I think we're going to see bad debt not really shift very much if these people don't pay. So it's not going to make things any worse. It might not make things as much better as they were expecting under the Affordable Care Act, but it's not going to make things necessarily worse. I do, though, think that a company like AmSurg Corporation, which does a lot of specialty ambulatory surgical centers, so things like gastroenterology, the sort of thing where you don't usually have a high bad debt ratio. They've got about 2.5% for the last 3 years. That's going to be a bit more of a concern for them, I think, because these people are going to come in, they're going to expect them to be insured, right? This isn't sort of your classic emergency department in a hospital issue. And then perhaps some of these people are not going to pay, and then they're not going to even get the insurance reimbursement on the other end. So that could be a bigger concern for them. How much of a concern? Hard to say. I don't think it's going to really make that much of a difference, but still something we'll want to watch.
All right. Well, and speaking about things we're watching, Obamacare enrollment is really the thing everyone's watching.
Sure.
I know you guys out there are. Michael and I are watching it. If there was a website that we could auto-refresh and get the new number, we would just be clicking on that all day long.
We would.
And it's sad but true. And the new enrollment data, we got an update that came out earlier this week, and it said we had crossed the 5 million person threshold. And so let's play a game of over-under, Michael. Do you think the CBO, Congressional Budget Office, projected 6 million people? The original target was 7 million. Obviously, that's been washed out thanks to the delays in getting the exchanges up in October. So we have the CBO projection of 6 million. Avalier had 5.4 million. They calculated a little differently by people who have paid, so there's a little bit of a delay there. We've seen some estimates actually in the low sixes, so over that 6.2 is about the highest I've seen. What's your over/under, Michael? Where do you see it? Let's play closest to the pin, and we'll check back in.
Okay, sounds good. I'm going to go ahead and commit to 6 million. I think that the
6 million firm, so not 6.1.
I'm going to say 6 million or over, but yeah, we'll go ahead and go for 6 million firm. When you look at the last 2 weeks, 800,000. Have signed up. And what we're really seeing is some additional work in some of the exchanges. Colorado's exchange, for example, is indicating that they're seeing a last-minute surge. I think we're going to see more of that across the country, especially in some of your low-performing states and especially in some of your big states like California and Texas and New York, where you've got groups pulling out all the stops. I think they're going to go ahead and increase that 800,000 in 2-week run rate to a million in 2 weeks.
And get right at 6.
And get right to 6.
All right, I'll be the contrarian here. I'm going to say right under. I was actually originally guiding for 5.7, and then when I saw this data, I was like, yeah, it's probably a little low. So I'm going to say 5.9. I think they just miss. I think it gets close, and then I think there's going to be all the brouhaha over, well, it was close to 6, and other people saying, no, it was a failure, it didn't hit the threshold. So I'm going to say 5.9. I think a million in 2 weeks is a lot to ask, even though we are seeing enrollment surge. But that's something to watch. Although, let me ask you this, Michael.
Sure.
Does it matter? I mean, does it matter if it's 6.1 or if it's 5.9 to any of these insurance stocks?
Fundamentally, probably not. I mean, okay, day of, absolutely, it's going to matter, I think. I think we will definitely see some price movement because of one thing or another, investors being bullish or bearish on sort of what's happening in these exchanges. But ultimately, these exchanges are not that fundamentally important to the business model for these insurers. You look at Humana, which expects to lose money. They're a Medicare Advantage play. That's a lot of what they do. You look at WellPoint. They reported 500,000 signups as of January out of 35.7 million people. Aetna said, we expect to lose money on the about 200,000 people who've signed up so far. 3% of revenue, 1% of EBITDA comes from the individual insurance market. I just don't see how this is that fundamentally material to the investing thesis right now. Long term could be different.
And if you are concerned about how stable these exchanges are, it's not going to be whether it's 100,000 above or 100,000 below 6 million. It's what does the mix look like? And we have seen a surge of younger people overall in the last couple of weeks. The Two Ferns interview, which we talked about the other week, actually did help get enrollment from younger people. So I'm really actually more interested in the mixed data, but it'll be fun to see who was right, whether we get over 6 or under 6. So stay tuned for that. Thank you for watching Market Checkup, and check back at Fool.com for all your healthcare news as well. Thanks for watching, and Fool on.